I want to discuss the concept of cash flow from a corporate finance perspective. In a previous tutorial, I presented a brief discussion of the statement of cash flows, which is an important piece of financial information, but that's not really what we're interested in here. In corporate finance, we're interested in the cash that's generated from utilizing assets and how it's paid to those who finance the asset purchase. So we're looking at shareholders, we're looking at bondholders, we're looking at operating income. So there are a couple of formulas here. Let's see if we can look at these. Cash flow from assets, there are a couple of ways to compute this. One way to compute it is by looking at it as operating cash flow minus net capital spending, so that would be spending on plant and equipment, minus changes in net working capital. Net working capital being investments in inventory, investments in accounts receivable, etc. You can also calculate it by looking at the cash flow to creditors plus the cash flow to stockholders. So it's probably easiest if we just look at an example here. And here we have an example from one of the textbooks I've been using. And we have a balance sheet and we have an income statement. And if we look at the first approach, cash flow from assets, operating cash flow minus net capital spending minus the change in net working capital. Operating cash flow is earnings before interest and taxes plus depreciation minus taxes. Now you might be asking yourselves, why do we add depreciation back? Well, we add depreciation in because depreciation is a non-cash expense. Depreciation needs to be in the calculation. If you look over here at the income statement, you'll see that we've subtracted out depreciation before we computed earnings before interest and taxes. Now you might think, well, why subtract it out if you're just going to add it back in? Well, depreciation does affect cash flow because it affects the taxes that are paid. You can deduct depreciation expense, that lowers your tax, that has an effect on cash flow, but because you don't actually pay out depreciation, the $10,000 in depreciation you take is not actually paid anywhere, it's just used to reduce your taxable income, we need to add it back in. So let's see what we have here. If we go to this, if we follow our formula here, EBIT is 694, depreciation is 65, and taxes are 212. Okay, tax expense is a real expense. It does affect cash flow. You actually write a check to the government. So if we do that calculation, we have operating cash flow of $547. Now, how about the change in capital spending? Well, it's going to be the ending net fixed assets minus the beginning net fixed assets. Okay, so you have a certain amount of fixed assets at the end of the period. You subtract out what you had at the beginning of the period, and you add back in depreciation. So we can go over here to the balance sheet, and we can see that they ended in 2010 with $1,709 of fixed assets. They had $1,644 in 2009, so we subtract that, and then we add back in the $65 in depreciation. So that tells us how much we spent on capital or fixed assets. And then we also want to look at the change in working capital, net working capital. So what do we do here? Let's take a look at our ending net working capital. So we go over here, and we can see that we have current assets. Okay, net working capital is current assets minus current liabilities. And over here, our current assets are 1403 minus $389, which our current liabilities are, so that's our ending net working capital. 2010 current assets minus 2010 current liabilities gives us our ending net working capital. And then similarly, in 2009 we had $1,112 in current assets, and we subtract out the 2009 current liabilities of $428. So that gives us our beginning net working capital, and you subtract one from the other and you get $330. And so you go to this formula, operating cash flow minus net capital spending minus change in net working capital. So you get 547 minus 130 minus 330, and you get 87. And again, it makes sense. This is money that's coming in, and we subtract out the money that was spent on capital expenditures, and we subtract out the money that was spent on changes in working capital. Okay, let's look at the other formula. Here we can use the formula cash flow from creditors plus cash flow from shareholders. Cash flow from creditors is interest paid minus any net new borrowing. So if we go to the income statement, we can see that we spent 70, and our net new borrowing, we go to the balance sheet and we look at the change in debt. In 2010 we have 454. In 2009 we have 408. So 454 minus 408 is 46. So 70 minus 46 is 24. So that's our cash flow from creditors. Our cash flow to shareholders, dividends paid. Again, we can go over to the income statement. Dividends are 103. Any net new equity, again, go back to the balance sheet, and we can see that paid in surplus under owner's equity here is 640. Common stock and paid in surplus is 640. It was previously 600. So you added 40 to that, so 103 minus 40 is 63. Add the two together and you get 87. So again, notice that we get the same number whether we use the first formula or we use the second formula, and you should get the same answer. Okay, they come from the same place, they're derived similarly. Okay, nice little table to summarize this is that cash flow from assets equals cash flow to creditors plus cash flow to stockholders. Okay, that's what we just did. That was the second formula we applied. The first formula we applied, operating cash flow minus net capital spending minus the change in net working capital. And you can see the definitions of operating cash flow, net capital spending, change in working capital, etc. So one good check is to do it both ways to make sure you get the same solution. When we start to look at project analysis, capital budgeting, oftentimes we will use these concepts of cash flow in order to determine the cash flow from a project that we're evaluating, and then we'll apply tools like net present value or internal rate of return to evaluate those projects.